What is going on, guys, and welcome back to another very exciting video. In this video, we are going to be taking a look at Disney, and Disney is not a stock that I own, but it is one that I've kept on my watch list for a very long period of time just because of the amount of volatility that we've seen in this company over the last couple of years. So what I want to do in this video is I want to take a look at Disney's recent news. I also want to look at their revenue, their EPS numbers, their shares outstanding, and then I want to go back around 5 years ago to an acquisition that Disney made that I believe is still affecting the stock to this day. So if you enjoyed the video, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. Let's start off by taking a look at Disney's stock chart. We could see that over the last month, Disney is down 6%. Over the last 6 months, down almost 11%. Year to date, down 6%. Over the last year, it is down almost 26%. And if we go over the last 5 years, we could see that Disney is down over 23%. And there's a lot of interesting volatility in this company. We could see that in 2020, it fell a very large amount from around 150 to a low in the 80s. And from there, the stock rebounded nicely over 2021 up to almost $200. However, from this all-time high to where the stock is trading at now, we could see that it is down almost 60%. In terms of recent news around Disney, Disney and Charter have been in talks about what types of channels would be offered on Charter's cable packages. And Charter has actually been holding out on the deal because they want more access to the streaming services that Disney offers. And this has been massive for millions and millions of customers of Charter because a lot of Disney channels, including ESPN, have been removed from their cable packages. However, a deal was just reached where Disney is allowing Charter customers access to ad-supported apps such as Disney Plus and ESPN Plus included in their cable packages. Overall, this is a good thing for both Disney and Charter, especially Charter, because one of the things that investors have been worried about with cable companies is whether they could stay relevant with all of these streaming services popping up. So with Charter gaining access to Disney streaming services, now they can offer them as part of their cable packages, and this will allow them to retain customers for longer. Let's jump into some of Disney's numbers. So in terms of their most recent earnings announcement, we could see that they announced their earnings back on August 9th. EPS came in at $1.04 versus 97 cents expected. That's a 7.5% beat. If we look at revenue, they were expected to report $22.53 billion. However, they reported $22.33 billion, basically in line with expectations. We can take a look at Disney's revenue numbers, and they have done a great job of growing their top line over the last few years. We can take a look all the way back in 2018, they were bringing in around $59 billion in revenue. Fast forward to today, and we can see that their trailing 12-month revenue is sitting at almost $88 billion. That is growth of around 30% over the last 5 years, and we could see that that growth hasn't been in a straight line. In 2020, they hit $78 billion. However, from there, they dropped down to $58 billion in 2021, but they have done a very good job over the last couple of years of consistently increasing their revenue quarter over quarter. We are seeing that growth slow down here over the last couple of quarters, where they got down to around 4% year over year growth in revenue. In my opinion, EPS is a little bit more important than revenue, especially for a company like Disney that is very well established. And if we look from 2017 through 2019, they were bringing in anywhere from $7 all the way up to $9 of trailing 12-month EPS. And if you look at their trailing 12-month EPS numbers, it seems like their EPS really dropped off at the start of 2020, which would make you think that the pandemic had a massive effect on Disney's business, and it definitely did. However, if you look at the third quarter of 2019, you see that their EPS dropped in a major way. It fell all the way down to 26 cents per share. And even though revenue has recovered very nicely over the last few years, we can see that their EPS numbers have not. They're only bringing in on a quarterly basis around 60 to 70 cents. And if we look at their trailing 12-month EPS, it's no longer up in the $8 to $9 range. It's sitting down in the $2 range. So when you look at those EPS numbers, it makes you wonder what is going on with the company. Is the company hurting in terms of their earnings, or have they increased the number of shares outstanding? And what we could see here is their shares outstanding over the last decade or so. And we could see that they were doing a fantastic job of decreasing their shares outstanding by around 3% every quarter. However, in 2019, we see this massive jump of 20% where they increased their shares outstanding from around 1.5 billion shares to around 1.8 billion shares. And what what ended up happening in the middle of 2019 is Disney ended up purchasing 21st Century Fox for $71.3 billion. And as part of the acquisition of 21st Century Fox, Disney proposed a bid of $35.7 billion in cash and 343 million shares of Disney. And we can see that those shares were added to the shares outstanding in June of 2019. And one thing to note is Disney has not bought back their shares as aggressively ever since that acquisition, as the shares outstanding has remained at 1.8 billion shares over the last few years. Overall, this was a big bet by Disney on their streaming services. They got channels such as FX, Fox Network Group, a 73% stake in National Geographic, and a 30% stake in Hulu. To get the deal to go through, they did have to spin off some of their channels, especially the sports channels, because they already owned ESPN. This included them spinning off Fox Sports 1 and 2 and Fox Deportes. However, they did get some movie rights and TV shows like X-Men, Deadpool, Fantastic Four, Home Alone, Family Guy, and Simpsons. These are all going to be important for Disney in the years to come as they really look to expand their streaming services. This deal has also had a massive impact on their free cash flow. We could see that in 2018, they brought in almost $10 billion in free cash flow. However, today, they are hardly bringing in $1 billion in free cash flow. They did see a recovery year in 2020 where that number jumped up to 3.5. However, it has fallen all the way down almost 50% year over year over the last 2 years to where it is sitting at now of around $1.1 billion. In my opinion, over the next couple of years, Disney really needs to focus on their free cash flow growth and their EPS growth. We could see that analysts right now have an average estimate for this year of $3.46 in EPS, a low estimate of $3.35, and a high estimate of $3.77. If we look out to 2024, the average estimate jumps up to $4.57, the low estimate increases slightly to $3.46, and the high estimate jumps up quite a bit to $6.46. If Disney was able to achieve this $6.46 in EPS next year, they would be trading at a current forward P ratio of 12.94, which would be fairly low for a company like Disney. In my opinion, Disney right now is not a buy. I am not looking to add it to my portfolio. I think it is trading at a very low price, but I want to see them start to show signs of turning around the business, because right now we're still seeing the business decline, and I want to see them get back to EPS growth as well as free cash flow growth. Right now, this acquisition over the last 5 years hasn't proved to grow anything besides the top line numbers, and that is great, but eventually at some point Disney needs to convert that top line growth into bottom line growth as well. So keep in mind, that is all my opinion. Do not buy a company just because some random guy on YouTube talked about it. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. So with all that said, I hope you enjoyed the video. If you did, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. And as always, guys, have a wonderful rest of your day.